Welcome back to the deep dive. Today, we're looking at HDFC Bank, specifically this post-merger phase. The integration of HDFC Ltd. It's created this huge new entity, HDFC Bank 2.0.
Right. And the market's view has really shifted, hasn't it? That's kind of the starting point.
Totally. So what are the sources telling us here?
Well, what's really striking is how the narrative changed. It used to be HDFC Bank was, almost a sure thing, a perennial growth story.
Guaranteed growth, yeah.
Exactly. Now, the sources are framing it much more as a complex integration story. And that really gets to the heart of it.
Which is?
Has this merger actually structurally damaged their profitability? Or is this just a temporary bump, a managed consolidation they have to get through?
That's the big question, and we need to be critical, right? The market's derated the stock, signaling some doubt. Is this really a rare opportunity for investors or just wishful thinking until we see proof?
A fair challenge.
So let's dive in. Where did the market see the first big red flag? You mentioned the liability side. Why did the stock get punished?
Okay, so the core problem, it was immediate. When they absorbed HDFC Ltd's loan book, remember, that was mostly funded by wholesale borrowing, not sticky deposits.
Right, different funding model.
Completely. So overnight, the combined bank's credit-to-deposit ratio, that's the key measure of how much they're lending versus the deposits they hold.
The CD ratio, yeah?
It spiked, went straight to 110%, which is just, unsustainable.
Wow, 110, okay. Huge funding gap. So what did management do right away?
They started a consolidation. And it was deliberate and, frankly, quite painful for growth. Their number one priority wasn't loans, it was getting deposits in the door.
So they slammed the brakes on lending?
Pretty much.
Yeah.
Loan growth slowed way down, just 5.4% projected for FY25. All focus was on grabbing deposits to pull that CD ratio down to a more manageable, say, 95, 96%.
And the cost of that fixation?
Well, it directly hit their profitability. The net interest margin, or not basically what they earn on loans minus what they pay for funds that got squeezed, compressed down to about 3.27%.
Necessary, I guess. But slowing down for a whole year, that's a big hit for a bank known for growth. So what's the long-term payoff? What new advantages, what moats are being built to justify this?
The sources highlight two big ones, things that didn't really exist before the merger. First, this huge captive cross-sell opportunity.
From the HDFC Ltd mortgage customer.
Exactly. Millions of them. And the stat is that something like 70% of HDFC Ltd's customers didn't actually have their main banking relationship with the HDFC Bank. They were just mortgage holders. Now they're in the ecosystem.
Okay, that's the story. But are these sticky customers? Are they opening real valuable accounts or just, low balance ones that cost more to service? How solid is this fix?
Well, the early data looks promising, actually. The bank's saying over 95% of new home loan customers are opening a SI account.
A current or savings account, low-cost funds.
Precisely. The cheap funding base they need. So that synergy seems to be working, tackling the funding issue organically.
Okay, that's one moat. What's the second?
Distribution. They're making a massive push into semi-urban and rural markets, the SURU areas. They're talking about reaching 200,000 villages eventually.
Building physical branches in this digital age.
Yes, but it's phygital, combining physical presence with digital capabilities. The idea is to build a trust network on the ground, something purely digital players. Well, they just can't easily copy that, especially in those markets.
Interesting. Okay, let's switch gears slightly. Risks. While management is focused inward on fixing things, what about the competition? We have to mention the ICICI Bank problem.
Absolutely, you have to. Because right now, if you compare them, ICICI Bank's execution is looking stronger on some key metrics.
Like what?
Well, HDFC Bank's core in IOIC, we said around 3.4%, right? That's quite a bit lower than ICICI's, which is holding up around a resilient 4.3%. And return on assets, ROA, HDFC's around 1.9%, while ICICI's is hitting 2.3%.
So lagging on profitability and returns. Any other risks?
There's also the asset quality angle. They inherited this complex sort of specialized real estate developer loan book from HDFC Ltd. It's chunkier, maybe riskier, and it currently shows a higher gross NPA ratio, 1.72%. That needs careful management.
Right. So clearly this isn't an overnight fix. It's a multi-year journey. What's the management's roadmap for getting back to, HDFC-style growth?
They actually used a cricket analogy, which is kind of helpful. They see FY26, the upcoming year, as the final year of taking singles. Meaning growing roughly in line with the overall banking system, maybe 10 to 12% growth.
Yeah.
Just consolidating, getting the house in order.
Okay, steadying the ship. And then
Then the plan is for FY27 to be the pivot. That's when they aim to start going for the boundaries. Again, growing faster than the system, trying to recapture that market-beating growth.
so FY27 is the target year for acceleration.
That seems to be the timeline they're signaling out.
Okay, so bringing it all together, what's the final verdict from the sources?
I think the consensus is, yes, it is fundamentally a structural, decade-long growth story.
Yeah.
But the sheer size and the complexity of this integration mean that the old days of 20% plus growth are probably gone.
So more moderate growth.
Yeah, expect something more like a resilient but moderated 12 to 15% earnings CAGR going forward. Still strong, but different.
Which really frames the investment thesis differently, doesn't it? Becomes less about guaranteed high growth and more about a re-rating story.
Exactly.
You look at the valuation now, it's trading near a 5-year low, price-to-book multiple, around 2.5 to 2.8 times?
Somewhere in that range, yeah.
So the bet for a patient investor is really on management hitting those targets, especially that FY27 acceleration, and getting the return on equity, the ROE, back up into that historical 15-17% range by, say, FY27 or FY28.
That's the core bet.
It feels like the market has priced in the consolidation pain. The risks are pretty well understood now. The potential upside from successful execution, maybe less so.
Which leaves a final thought, maybe a challenge for you, the listener. HDFC Bank is now this incredibly complex behemoth, operating at a scale few private companies match. Can management ever truly convince the market to give it that historical premium valuation again? Or has the perennial growth story simply matured into something different, something solid but less spectacular?
Has the premium gone forever? That's definitely something to mull over.